Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins Hutton, Director of Investor Education here at PassiveInvesting.com. And I'm so excited that you're joining me today. We have a special guest joining us today, Ben Michael. Welcome to the show.
Hi, Whitney. Thank you for having me. I'm excited.
Yes. Yes. Well, I'm so excited to talk about your property, the Morada, 71 units in Crystal, Minnesota. But tell us a little bit about yourself first. What's your background and how you got into multifamily real estate?
Yeah, my background is multifamily brokerage. I started in 2010 as a broker, did that for 10 or 11 years. And then 3 years ago, switched to the buyer side and started raising money and buying deals.
All right. All right. So do you have your own deal flow? That's what we're going to find out today.
Yeah,
So let's dive into this deal, the Morada 71 units, Crystal, Minnesota. First of all, let's kick it off. When did you purchase this property and for how much?
we bought it March 8th of 2024, just a few months ago. And purchase price was 6.64 million. It works out to about 94 a unit.
Okay, excellent. Well, let's back up that timeline. It's not like a single family rental or anything like that, where you find it, you close in just 30 or 45 days. When did you find this deal? How did you find
Yeah.
it?
This deal hit the market, I believe it was in December or January. It was a brokered deal, and which, by the way, right now I sometimes I prefer a brokered deal just because prices are depressed, and sometimes you need your seller to have an education from a broker to to fill them in on where prices are today. But so it was a brokered deal. It was marketed for a few weeks, and we ended up um, being the top offer. And Yeah,
Awesome. Well, how many people were competing for the deal?
I believe it was 6 or 7. It's pretty quiet out there right now. There's a lot of challenges with debt and insurance, so that's keeping some buyers out of the space. But I know we had a little bit of competition on the deal for sure.
So let's talk about how you structured the deal in order to win it. Like, what actually won this deal for you?
So the seller had a 1031 exchange, and timeline was big for them. I'm sure, I believe we were also the highest price, but they pushed for a 60-day close, and we agreed to a 60-day close, which, in the end, we got it done. But when you're raising money and you're, buying these properties and you're doing due diligence, 60 days is going to cause you some headaches. But um, we did get it done, and that was the big factor for them, was that short timeline.
Awesome. Okay. So 60 days to close. We got a 1031 exchange on the line. You guys are kind of racing to get this closed. Let's talk about in the contract structure, what was your timeline in order to do due diligence?
Right. Yeah. So we had 30 days for due diligence, 60 days to close, and we did allow our earnest money to go hard after that 30-day due diligence period. I felt pretty confident that we can inspect the property, do our financial due diligence, audit the leases, and move forward with it at that point. The only thing that I guess, we're taking a risk on if we're letting our money go hard after 30 days is that appraisal. And That's just a risk we're willing to take, I guess.
Hmm. So, okay, so you got 30 days to do due diligence, which is, a respectable timeline. At what point in time did you set foot on the property? Was it a time at LOI that you started going in and peeking into every unit, or was it a signed purchase sale agreement?
So during the marketing period, we probably stepped foot in 4 of the units. We got to see the mechanicals. And So we had just seen a small snippet of the property at that point. We put it under contract, and we had our due diligence tour within, I think it was within 10 days of getting it under contract. And at that point, we walked through every single unit. We brought in the trades, took a look at the boilers, the roof. We had the sewer lines scoped, looking for any elbows or, dips or roots or anything like that. So uh, we did all that within the first 15 days or so. And internally, we had green lighted the deal. It looked really clean. We were happy with it. And at that point, we started the capital raise. So, um, at that 15-day mark. So in effect, we've got 45 days from when we really roll out the capital raise to when we close. So it's, it goes fast.
Yes. Yes. Okay. So we've got the physical due diligence here. Our money is not quite hard yet. How much did you have down for earnest money?
1%. So we had $66,000 down. I've got a co-GP on this deal, so he and I split that. Yeah, so 1% earnest money.
Awesome. Okay. So you get the trades in there. You complete your inspection. Were there any surprises that came up, or was it as you expected?
This was a one owner 1970 built building. And typically when you think of one owner for an older asset like that, sometimes it can have a negative connotation because, you know, yes, they built it and cared for it for a while, but they might have kind of let things go. This owner did a great job. They really had put a lot of capex money into it. It had new windows, new roofs, boilers were within being 10 years old. So they had done a great job. They hadn't really focused too much on, watching where their expenses were. They hadn't focused on, upgrading the units at all. But overall, we were really pleased with the condition of the property. And it really, sometimes you peel back the layers and things get worse and worse. We really found some positive surprises as we moved through it, which was really nice.
No, well, that's great. And oftentimes in these 1970s builds, we've got issues with the sewer and,
Right.
galvanized piping and,
Right.
so
For example, we opened a door to a storage room, and it turns out that there were two saunas in the building that were original to the building, and saunas are pretty popular right now, and so we're gonna revive at least one of those saunas and make it an amenity. We found that on the due diligence inspection, and we found like a super high end. This is Minnesota, so we have these cold winters, and sometimes you need to put in a gutter heating system to make sure you don't get ice dams. And we found a $20,000 system in place that we hadn't noted earlier, and so we just found they really put a lot of thought into maintaining the property.
that's awesome. Well, let's switch to the financial due diligence. So you're well underway on the physical due diligence. You're starting to open your raise, which we're going to talk about here in a second. How did the financial due diligence on this property go? Were there any surprises there?
The financials were really tough. There wasn't much we could glean off of their P&L. So rents were low. They've got their caretaker is serving sort of as the property manager. Utilities were through the roof. I think our first one item we noted was the water bill. I think was nearing $1,300 per unit annually, and so we knew that there's some water that's being wasted. Um, I keep comps of every property I've underwritten, so I keep per unit uh, expense comps, so I could look back and see that a building like this in this neighborhood, the other buildings I've underwritten in that area, they're probably operating more at $700 per unit, something like that, whereas this one's nearing 1,300 per unit. So I really couldn't use much of the financials I was given, and I really had to just work off of my records from every other building that I've underwritten in the area to piece together my pro forma of where this will operate. And then on the income side, it was a matter of just doing full rental comp search and seeing exactly what renovated apartments are leasing for in the area, what they're charging for rubs, and then we just underwrote based on um, being competitive with those rents. We didn't, trend them, trend it upwards, or assume that even though we're going to have the newest, uh, most recently renovated units, we're going to rent for higher. We just kind of played it conservatively with our rent comps.
Mhm. All right. Well, I want to pull a couple of things out of what you just said, because if somebody's new to the multifamily space or even just not seasoned, there's a few things here that I think you gave some tips and tricks unknowingly. One, you keep every time you do your due diligence on any property, you have those records. So you have like a master list of what to expect for vintage types and area that you're farming in, right? To find property. That's huge. That is a lot of data. A
Yeah,
lot of
and
data.
it wasn't my idea. I took it from someone else, but it is huge. So every time I underwrite, I've got this, 10-page Excel document for underwriting, and it has a section that allows me to export that data onto my giant spreadsheet of every building I've ever underwritten. So it I don't actually have to do a lot of work to track that data. I just copy and paste the KPIs from my underwriting to my giant spreadsheet. But man, if you can, look and see what the water bill was on 15 buildings in the area, you can really feel confident when you're kind of buying a building with basket case financials like what we were buying.
Well, and the other thing here is, and you kind of cruise past this, I'm not sure everybody understands what a rub is. So, some people might be listening to this and go, well, why are you even paying for the water anyways? Wouldn't the tenant be paying for that? And
Right.
this is a 1971 build, not always the case. So,
Right.
what is the business plan? How are you planning to move that from the tenant, or excuse me,
Right.
from the owner P&L to the tenant?
Yeah, this is a 1970s apartment building. And especially in the Midwest, it's pretty common to have boilers for heat. So, landlord pays the heat and the water is all on 1 meter. So, um, the landlord pays for the water. And so we use third party contractors to put rubs in place. So that means the tenant,
And what's a
uh,
rub?
yeah,
Define that for us.
ratio utility billing system. And so what that means is the water bill is split amongst the 71 units, and it's split based on how many occupants you have. So you're splitting up the water bill as fairly as possible, considering how much usage will be there'll be in each unit. And then in addition, we can add in you know, a portion of the heat is split by the tenants through rubs. We're not splitting the entire, heating bill because they're common areas, and it just wouldn't be fair. But we are charging up to, I believe, $30 per unit per month for the heat bill when the heat bill, you know, reaches that point in the wintertime. And what this does in the end is it's just to be competitive when you're leasing your units. So if all my competing properties are charging rent and then they have rubs on top of that, their rent figure is going to look lower than mine if I'm not charging rubs. So they might be charging, $1,100 for a 1 bedroom, and then they have $70 in rubs, whereas I could be charging the same price but without rubs. It looks like I'm charging $1,100 and $1,170. So $1,170. Sorry. So it just looks like my units are more expensive when in fact they were comparably priced. So you just kind of have to. It's necessary, in my opinion, when your neighbors are all employing rubs.
Okay, very cool. Thank you for educating us on that. Now, you mentioned in the beginning that, a lot of people, competition's been pretty low because of inability to secure debt as well as insurance. Tell us, was there any issues in getting insurance on this property?
Yes. So um, it when you're buying right now, you're taking on a little additional risk because you don't know what your debt and what your insurance will look like. This property has stab lock breakers, and we saw those on our first tour, and we know exactly what that means. But what that means is, you have a replacement expense. Every single unit needs a new circuit breaker installed, and then your mechanical room also needs the breakers installed. And in the case of this building, I think the total cost is over $2,000 per unit, about 100, 140, $150,000. Um, so that's, you know, pretty easy to figure out. But what's difficult with insurance is we already have a tough insurance market, and it's already tough enough to insure a 1970s property, or at least to project what your insurance expense will be. But most insurers that we approached just would not even consider, insuring us while we have these stab locks. And so it was expected. We know it's a short term issue because we're replacing all these breakers, but we ended up just signing with the in place insurance company because they were fully aware of the building and its breakers, and so we'll put it back out to the market and for insurance in 2 years when we have all um, appropriately upgraded breakers. But it was extremely difficult finding insurance.
Mm. Well, let's pivot to the debt because that's the other puzzle piece, it seems like, in today's market.
Right.
Tell us what kind of debt you have on this property. How did you find it? Was it, and all the various details, interest rate, public, private,
Right.
all the good stuff.
Yeah. So this deal is in my backyard. So I have existing bank relationships. I have debt with 5 different banks. But it's a tough time to find bank debt, and we're doing a value add. So we need a construction loan. We want, um, in our case, we ended up getting a 75% LTC loan to cost loan. But so many banks, all they wanted were stabilized assets, and they didn't want to deal with a property that needs to go through a reposition. So I talked to my existing relationships, people who I currently have loans with, and I would say maybe 2 of them even responded to me. The rest were just, they're just worrying about deposits, and they don't have enough deposits, and they're just out. Um, and the 2 got back to me and offered me okay terms. So we ended up putting it out with a broker. He brought it out to 30 plus banks, and we got back, I think, 6 local lenders who were willing to offer terms that are, competitive. There were probably another 10 lenders who were offering just crazy terms, but it's funny, they returned term sheets, but they were just, 100 basis points higher than the other players. So uh, our broker sourced us the debt. It ended up being one of my relationship banks, but the terms were much better after a broker put it out to the market. We got a 70% loan to cost loan, 7% interest rate, 5-year term, and a 30-year AM. And and it's with a bank that we know is well versed in multifamily. So we're going to be doing construction draws every month, and we want to make sure this bank is decent to work with when you're doing your construction draws, and if they're and make sure that they can pay your contractors quickly. So it was great that we uh Bridgewater Bank is a local bank in Minnesota. They're well versed in multifamily. It was great that they ended up being really competitive on terms, because then we knew that we could run the construction loan smoothly with them.
Mm. And so is your plan to refinance out this deal in a particular time period?
We have a prepayment for 3 years. Ideally, it'd be great to go into Freddie or Fannie debt at that point. My company, Ridgeview Property Group, we buy properties to hold long term, whether we're holding this asset for 20 years or we exchange out of it into another asset. Our goal is to avoid the sale and avoid, remain tax efficient and avoid paying tax capital gains. So either we will sell if we have a 1031 lined up, or we will go into Freddie or Fannie debt and put 10-year debt on it and hold it for 10 years. And so we're just trying to have long-term cash flow without too many taxes.
All right. So let's talk about how you structured this deal. You said you had one co-GP, but also with your limited partner. So let's start with the general partnership first. How did you structure that deal, and who took what role?
Yeah, my partner on the deal, Scott. So first time he and I had partnered, and but we both had a similar background, similar time spent in the business. We're both had been, syndicating for 5 years or so. And so how we structured it between he and I was both of us were signing on this personal guarantee. So we're both signing on the debt. We split the earnest money, and we're both our balance sheets are being used to qualify for this loan. So it was a 50-50 split between my partner and I as co-GPs. Um, in terms of how we structured it for investors, we did a 75-25 split. So 75% to the LPs, 25% to the GPs, a 6% preferred return, which kicks in at the beginning of year two. And the reason why we go for a 6% preferred return is, we're shooting for this deal to hit a minimum of a 7% cash on cash upon stabilization. So I like to have a little buffer where we're, cash flowing 7%, but we're paying out a 6% pref.
Awesome.
Uh,
And any other IR hurdles in there?
no hurdles. We just keeping it simple. The goal here is cash flowing and paying off our investors both their original investment, paying off their pref, and then just enjoying a 75-25% split off into the sunset.
Excellent. So let's talk about, did you charge any fees to this deal? Like acquisition,
Yes,
asset management?
yes. So we charged a 2% acquisition fee, and my partner and I split that 50-50 as well. And then we have a 1.5% asset management fee on the gross income each year. No disposition fee. And then management is third party, managed by a good friend of mine. And so that's 5% annually for management.
And is it on-site management?
They they have a leasing agent. We do have an on-site office, and we get they have a leasing agent that we probably take 75% of her time for this asset, and then she also has other assets she goes to. But we have a nice leasing office now, so I think she's going to spend a lot of time at our building.
Awesome. Awesome. Well, Ben, I have two questions for you as we wrap up. What did you find easy during this transaction that you thought was going to be a little bit more challenging? And what did you find that was harder that you thought honestly would be easier?
Sure. Easier, I would say, would be the capital raise. Things were quiet over the last year. I didn't buy anything since 2022. And during that time, I really focused on, lunches, coffees, and just um, reaching out to investors. So that all really paid off when it came time to capital raise here. I know it's a tough time to raise money, but we raised about 2.75 million, and that went pretty smoothly. And then I would say harder than expected was insurance. I thought we would have more options than we did with stab locks, but it's rough out there, and we're happy we got it done. We locked in an insurance carrier who fully understands the situation of stab locks, and so yeah, that would be for sure. The insurance was the tough part.
Hmm. Well, Ben, thank you so much for spending your time here with us and sharing your knowledge and expertise. If listeners want to find out more about you, how can they do so?
Absolutely. Yeah, thank you. My website is ridgeviewpropertygroup.com. That's my firm, Ridgeview Property Group. And on the website, you can either join my newsletter, there's a link, or you can hit contact and reach out to me, and we'll have a conversation.
Excellent. Well, Ben, again, thank you so much for being on the show today. We look forward to hearing about your future deals.
Thank you, Whitney. Appreciate you having me.